Let's check in on the strides that just one oil marketer over in Kenya is making right now. And for that, we're joined by Patrick Kondo. He's the regional manager at Kenol Kobil. Thanks so much, Patrick, for joining us this afternoon. Well, we've seen Kenol Kobil revise its full-year earnings outlook following the firm run that we saw in the second half of last year, mainly in your Kenyan operations. Run us through what's driving profitability for the firm right now.
Thank you very much. Good afternoon. Actually, my title is Mergers and Acquisition and Regional Support Manager, meaning that I deal with the mergers and acquisitions, and as well I supervise and coordinate the activities of subsidiaries. Now, going back to your question about profitability, yes, our profitability revision was driven by the fact that one, certain activities in the second half of the year have made it possible for us to predict a higher profitability than initially intended. If you remember, at the 6 months, at the end of 6 months, we issued a profit warning telling the investors that we expect our profits to be below what would be expected. However, second half was very strong, the margins were much better, and coupled by the fact that on the international market the oil prices were more or less stable, this has made it possible for us to predict better profitability for the second half. But in addition to that, our subsidiaries, our 7 subsidiaries, have made substantial contribution in the second half as well and for the whole year to make it possible for us to register much better results this year than we initially anticipated.
What's interesting, though, is that this comes at a time when we've seen several multinational oil marketers leaving the country, citing depressed profit margins as responsible for their exits. What kind of profit margins are you looking at?
Well, right now it is not possible to disclose that because we are a public company, and until the books are audited, we cannot be able to divulge the information in specific terms. However, what we did in the second half is to change our operation model, and also the matters impacting on the KPC and the arbitration case which we had with them, as already published in the newspapers, have made it possible for us to predict better returns. Now, coming to the issue of the multinationals exiting Africa as a result of the depressed profit margins, we, first of all, we are purely a downstream company. Being a downstream company, we cannot exit Africa in any case. But the multinationals who are exiting, they are making a comparison between the earnings they make in the downstream in Africa and the earnings they make in the upstream. If you realize that when the multinationals are exiting Africa, they are only exiting from the downstream. They are not, I mean, from the downstream, yes. They are not exiting from the upstream. But for us, we are a downstream company, and what we are doing is to enhance our investment, to take advantage of the opportunities which are coming as a result of this exit, to increase our profitability, and as well as developing other areas of the business, including LPG and lubes and so on, to improve our profitability.
Diversification aside, you're also entrenching yourself even further in terms of a regional footprint, to the extent that we've got regional expansion very much on the cards for the company. We've seen you just acquire 10 more stations over in Burundi. Run us through your regional strategy.
Okay, let me start by in general terms. In general terms, our vision is to become a market leader in a leading brand in every market we operate in, and one of the biggest players in Africa. And we are determined to achieve this vision. So recently, of course, we acquired 10 stations in Burundi, and prior to that we had acquired another 4, meaning now we have 14 stations in Burundi, a market where we entered only October last year. In terms of investment and in the retail network, we are now the second largest oil company in Burundi, and we have plans to grow further. In Burundi, we want to replicate the model which we used in Rwanda, where we started with one station, and as of now, we are the market leaders with over 30% market share, and we have the largest number of retail service stations in Rwanda. So in Burundi as well, we are not going to stop where we are now, but we are expanding in the market, both in the retail and in the lubricants. We also expect to use our footprint in Burundi to expand and increase supplies to the neighboring countries such as the Congo, the DR Congo.
Well, that's just one of the ventures that you're currently taking on. There's also your ventures into Zimbabwe. I mean, we've got Engine Petroleum and Kenol Kobil planning to acquire BP and Shell's Zimbabwean assets. Looking at that opportunity, I mean, when do you see it playing off? Because most investments getting made here are made with a long-term perspective.
We are currently in Zimbabwe finalizing on the statutory approvals, which we believe will be the process which will be over soon. True that Zimbabwe is just evolving or coming out of a downturn, economic downturn. But we see a lot of value in Zimbabwe because this country has got excellent infrastructure, very well developed depots and service stations, and we want to be part of the growth in Zimbabwe. As you know, we are an African oil company, and we believe that even at times when an African country has problems, we want to be there with them, and as they come out of the problems, we want to be part of the growth.
Well,